Hello everyone, this is Harish. Welcome to the knowledge series on economy, finance, and banking. Nowadays, there is a lot of talk around digital currencies. In the recently concluded G20 meeting, it was one of the agenda for discussion. During the meeting, governments and central banks have expressed their concerns on the rising popularity and uses of cryptocurrencies. They propose to put in place necessary mechanism to curb the rise of cryptocurrencies. To understand wider perspective, I have chosen a topic for discussion as digital currencies to begin with the knowledge series. So let's begin discussion on digital currencies. Digitalization is a buzzword. Business operations and processes are getting digitalized to get efficiency gains. Consumer experiences are getting digitalized. To support this digitalization, there is a need of a payment system which should be fast, secure, cost effective, agile, and efficient. Central banks across the globe are upgrading their payment systems to pace up with digitalization. They are implementing fast payment systems. This fast payment system in India is known as UPI. In Australia, it is known as NPP. In Brazil, it is known as Pix. And very recently, US has also launched its fast payment system which is known as FedNow. Though central banks are upgrading their payment systems to support digitalization, there are new form of private currencies are emerging to compete with central bank money. These private currencies are known as cryptocurrencies and stablecoin. These currencies have edge over central bank backed payment mechanisms and provide lot of efficiency gains. These currencies are not supported and controlled by central banks, hence these are attractive mechanism to defy government restrictions on payments. Central banks are of the opinion that these currencies can pose risk to financial stability. Hence, they want to curb the uses of these currencies. They are deliberating and putting in place necessary infrastructure to launch their own digital currency. In this series on digital currency, we will discuss why private digital currencies are emerging. What are the benefits these currencies offer and what are the impact of private digital currencies on economy and financial stability. We will also discuss why central banks want to launch their own digital currency, what purpose it will serve, and what are the impacts of central bank digital currencies on economy and banking system. So let's start our discussion with the concept of money and currencies. What is money? The concept of money is very fascinating and its history goes back to thousands of years. Money has evolved over the period. Earlier, we were using barter system, then we moved to coin-based payment systems, and thereafter to currency notes. Presently, there's another transition in process. This transition is towards digital currencies. Though money has evolved over the period, its defining features remain same. So what are the defining features of money? First, it has intrinsic value. Second, it acts as a medium of exchange for goods and services. Third, it has store value. Any form of money which fulfill these defining features are known as money. Money can be in the form of commodities, precious metal, or currency notes. We can broadly divide money in two parts: public money and private money. Public money refers to money issued by central bank. Central banks plays a very important role to ensure trust in money and make it as a public good. On the other hand, private money refers to money which is not issued by central bank, and we are very familiar with the concept of private money. We are dealing with private money very widely in our day-to-day activities. Some examples of private monies are gift card, payment vouchers, coupon, etc. Bank deposits is another form of private money. Bank deposits are issued by banks under the license of central bank. These deposits can easily be convertible into cash or central bank money, hence we consider it similar to central bank money, though it is not. There are new form of private monies are emerging to compete with central bank money. These new form of monies are known as cryptocurrencies and stablecoin. What is currency? Currency is a debt instrument. It is issued in the form of a promissory note. Currencies can be backed by commodities, precious metal, or these are merely issued as a promise. So let's understand what are the defining features of currency. First, it is a debt instrument. Second, it is issued in standard denomination. Third, it is used as medium of exchange for goods and services. Fourth, it irrevocably extinguish payment obligations, which we call it as payment finality. And fifth, it is a liability for the issuer, an asset for the holder of currency notes. In modern days, currencies are only issued by central banks, and these currencies are not backed by any assets. These are issued merely as a promise. So the question arises, in the present fiat monetary mechanism, where currencies are not backed by any asset or commodity, then how these currencies derive value? Though explicitly currencies are not backed by any commodity, unlike gold standard and Bretton Woods standard, where these currencies were backed by gold, but implicitly it is a claim on the resources of central bank, or it is a claim on the resources of a country, hence it has intrinsic value. Second, only central banks are allowed to issue currencies, hence they have monopoly. These currencies are used as a medium of exchange for goods and services, which creates demand for these currencies and hence create value. Third, it is issued as a legal tender, and payment through currencies irrevocably extinguish payment obligations, which we call payment finality. All these together create value for currencies. Currencies can be broadly categorized in two parts: physical currencies and digital currencies. Physical currencies refer to currencies which are issued in physical form like cash and coins, whereas digital currencies refer to currencies which have similar feature like physical currency but issued digitally. When these digital currencies are issued by central bank, we call them central bank digital currencies, and if these currencies are issued by any private issuer, we call them private digital currencies. With the advancement of technologies, there are new private digital currencies are emerging to compete with central bank currencies. These currencies are known as cryptocurrencies and stablecoin. Both these currencies, private as well as public currencies, both represent fiat monetary mechanism. Hence, these are promises and not backed by any asset. So, in case of central bank digital currencies, we are carrying sovereign risk, whereas in the case of private digital currencies, we are carrying credit risk on the issuer. So here we wrap our discussion. Thank you for watching the video. If you like the video, please subscribe to the channel. We'll come up with the more videos on the subject. See you with the new video. Till then, bye bye.